from the beginning, I've been bullish on Bitcoin and I've been bullish on the growth of stablecoins. But that bullishness doesn't really extend to other cryptos.
You're listening to Hopium Radio.
Well, Bitcoin's always like more volatile than people expect. I mean, I would have liked to have seen 150K. This year, we only got to 126K, which is not too far off, but it's a little bit on the disappointing side. In general, I think, you know, there is a little bit of treasury, like those treasury companies, you know, some of their MNAVs, their market value to net asset value, got a little bit excessive. We also started to see altcoin treasuries, which I don't think was a particularly healthy development. So I think it's natural for a lot of that space to get washed out, even though, you know, some of the leading ones I think are healthy overall. They have pretty low debt to you know, Bitcoin ratios. So I think as we see that right size, as we see some selling, I also think there's kind of a self-fulfilling prophecy. So Bitcoin hit a multi-year peak in Q4 of 2013, then it hit another major peak in Q4 of 2017, and yet another major peak in Q4 of 2021. Basically, it's kind of in line with Bitcoin's kind of 4-year supply halving cycle. So I think investors are spooked that if it didn't reach their targets here in Q4 2025, that they might have to wait multiple years for their next run. That's where I would generally disagree, and I think that, you know, we're no longer on a 4-year clock. So I think there's some selling that basically fear that we are, but there's no particular kind of supporting reason that cycle would still be in effect. So I do think that in the next couple of years, I think Bitcoin is still well positioned, and right now, basically, a lot of the leverage and sentiment has been washed out of it.
Yeah, you brought up strategy. I have to ask you, I mean, it's kind of the elephant in the room as we kind of go about it. I mean, the stock has been obviously extremely volatile. The premium kind of collapsed, and analysts are openly questioning the balance sheet risk. I mean, it's a company with billions in leverage tied directly to the Bitcoin's price. I mean, how concerned should investors be about concentration risk there? I mean, does the strategy model work in an environment where liquidity is tightening and the ETF market now absorbs most of the institutional flows, or, you know, is the market kind of finally just repricing the idea that a corporate balance sheet can function as a Bitcoin hedge fund?
Well, I think they're repricing it. I mean, I don't think that the 3 times MNAV it was trading at was sustainable. I mean, there were other ones trading at even higher MNAVs, like MetaPlanet was at something like an 8 times MNAV back in June. I don't think those levels are sustainable. I do think that Bitcoin with you know, non-callable leverage attached to it, the type that corporations can issue, is pretty attractive and can warrant an MNAV above 1, but there's a kind of a range that makes sense, and I think that a 3 times MNAV doesn't really make sense. So there's been a repricing, and I still think the business case itself makes sense. You know, I would like to see more of these treasury companies have cash flows to support their interest expense. But when you look at how most of them are structured, you know, the top ones like Strategy or MetaPlanet, they've got pretty low debt relative to their assets. You know, so you know, during the bull market, MicroStrategy has something like 20% debt and preferreds as a percentage of its Bitcoin. Now it's a little bit higher because Bitcoin's gone down, but even their preferreds are not, you know, exactly debt, and so the actual debt portion is still quite a low percentage of their Bitcoin holdings. So it's fairly conservative leveraged, but it does make sense that investors would be spooked when they're holding it at 3 times MNAV, or even when it's back down to 2 times MNAV, that they'd want to kind of right size that position. So I think we've seen kind of this over euphoria in the space. I think there's going to be, you know, there's an ongoing washout of the weaker ones, the ones that were kind of poorly capitalized or poorly run, or, you know, bet on the wrong asset. But I think as it kind of washes out, I do think that a handful still makes sense as long as they're conservatively run. And of course, the differentiation that they have compared to ETFs is that if an investor is bullish, you know, they can buy unlevered Bitcoin, which, you know, I think makes the most sense. You generally want to have your core position be unlevered. Ideally, you can buy it and take it into self-custody, but if you're the type of investor that's going through a brokerage account, the ETFs are very useful. But then for bulls that want a little bit more leverage, it's still conservative leverage, but it's some leverage, and so it is a differentiated security than you get from an ETF or from owning the underlying itself.
Yeah, well said. And I guess that brings us to your new letter, because this section will surprise a lot of people. I mean, you argued that for most cryptocurrencies outside of Bitcoin, obviously utility is not a bullish trait. It's more of a trap, because once a blockchain becomes purely a utility rail, it competes like a commodity. You know, fees fall, margins compress. and returns vanish. You compared this to the ETF industry, trillions in assets, but the issuers capture very little value. Are you saying that the high utility is actually kind of bearish for a token, that these networks will be very useful to society but terrible long-term investments?
Pretty much. I basically would say that that puts them in the category that look more like equities. So, from the beginning, I've been bullish on Bitcoin, and I've been bullish on the growth of stablecoins. But that bullishness doesn't really extend to other cryptos. That doesn't mean that there's still not some that are useful. I mean, obviously there's some things serving as the tech rails for the stablecoins and other types of assets. But that my argument is that the overall market value of those is unlikely to grow very large. As evidence of that, I mean, if you look at the ETF industry, there's over 13 trillion of ETF assets that are, basically a handful of companies issue the majority of them, and those companies are worth less than $200 billion. It doesn't take a lot of kind of operations to run this really big platform, and the same thing's true for the big stock exchanges in the world. The company, the two companies, New York Stock Exchange and NASDAQ, that are responsible for the vast majority of U.S. market cap, tens of trillions of dollars. Collectively, they're worth less than like half of Ethereum. And so when people look at these crypto assets and they say, well, this is going to serve as the tech rails for billions or trillions of dollars of stable coins and trillions of dollars of tokenized, whether it's real estate or art or equities or whatever you have it, the numbers that they have to reach in order to make these things worth what they already are worth are extraordinarily high if you look at them on any sort of revenue basis and kind of treat them as though they're a tech equity. And so basically there's a lot of competition between utility protocols. I think you price them like those tech rails, and the only one that I think is basically worth being a multi-trillion-dollar asset is potentially Bitcoin, because that's the one that's bought for its own sake. It's bought because people want to hold Bitcoin. They want the leading network effect and security for portable capital. So that can potentially warrant it as long as it remains decentralized and secure, and kind of the best at what it does. But outside of that, I think the valuations are quite high.